Welcome to MA1 class. This is session number 5. We are looking at accounting for material costs. In this chapter, we look at how material costs are accounted for and how inventory can be valued. Raw materials are purchased and then undergo further processing in order for a company to come up with finished products. So at the end of the period, more especially in manufacturing companies where production takes place as a continuous process, at the end of the day, at the end of the period, you may have incomplete units, which we call the work in progress. So incomplete units refer to the partly made products which are not yet finished, and you may also have the finished products. These are products that are 100% complete. Material progress through a factory as follows. First of all, materials are purchased from suppliers. So material comes into the company. Of course, you may store it, and then these materials are used to produce goods and services. So at the end of the period, you may have both work in progress, incomplete units, and finished goods. Finished goods, of course, go to the customers. So the movement of materials between each stage must be accounted for in the form of the T accounts. What I want to focus on in this particular video are the different methods that are used to price material issues from inventory, and also the value of the closing inventory. So there are different approaches that can be used to value inventory or to price the material issued. So amongst the following methods, we've got the FIFO. FIFO means phased in, phased out. So the FIFO method assumes that the goods that arrive phased are the phased to be used. The materials that arrive phased are the phased to be used. So phased in, phased out, that's what FIFO means. The other inventory valuation method or pricing method for material issues is LIFO. LIFO stands for last in, phased out. So under LIFO, we assume that the goods that arrive or the materials that arrive last should be the phased to be used. The material that arrive last should be the phased to be used. That's the LIFO, last in, phased out. The other method that can be used is the cumulated average. Under the cumulated average, every time you add materials, you need to calculate the new average price. So at every stage before you make an issue, you calculate an average price, and that becomes the price for issuing materials. Periodic weighted average method. Under this method, you calculate the new inventory value at the end of the set period. So at the end of the period, you have to calculate the new inventory value and use it for the valuation of materials issued and also the valuation of the closing inventory. So the formula for calculating the average value, the average inventory value at the end of the period, you just have to take the cost of the opening inventory plus the purchases that were done in that particular period. That gives you the total cost. That cost divided by the opening inventory units plus the units purchased. You get the average cost per unit. So let's look at an example here. We've got an example. Recent results of a division are given as follows. So we have the date. The opening inventory was 1,000 units. Unit price was 5. Then on the 5th of April, there were purchases of 500 units. The unit price was that. Then on April 9, there was a sale or issue or sold units of 200. We need to calculate the value of that issue. 14th of April, there was a purchase of 600 units at the price of 5.5. On the 21st, there was a sale or issue of 1,200 units. We need to calculate the cost of issue. So the question is, calculate the cost of inventory used and the cost of the inventory remaining at the end of the period using each of these inventory valuation methods or pricing methods. So we are calculating two things here. The first one is the cost of inventory used. The second one is the closing inventory. So let's start with our first one, using the FIFO method. Using the FIFO method, we've said FIFO stands for phased in, phased out. So there you are making an assumption that the inventory that came in phased should be the phase to be used. Inventory that came in phased should be the phase to be used. So as part of the solution, let's go back to the table. So what we are noticing from the data that is provided, or the results provided, is that we've got an issue that is happening on 9th of April. 9th of April, that's 200 units issued. 200 units issued. Following the FIFO phased in, phased out, these 200 units will come from the earliest consignment received. The earliest consignment that we have here is the 1,000 units that is part of the opening inventory, and the value of those units is $5 per unit. That's the unit price, $5. Of course, you can put this in dollars. So let's say $5, and we have 1,000 units in inventory, the earliest inventory that we received. So 200 will be issued from that, and the price is $5,000. So we'll say issue on the 9th of April. So 9th April, we have an issue or sold. Those units are 200 units, and these units are coming from the earliest consignment that we had, 1,000 units. There it is, multiplied by the value of those units. The value per unit is $5. So multiplied by $5, that's the cost of that issue or sale. That's the cost of that issue or sale, and this is going to be $1,000. $1,000. $1,000. We have another issue that is happening, or another sale that is happening on the 21st of April. 21st of April is a sale of 1,200 units. So 1,200 units should come from the earliest consignment that we have, and the earliest consignment here, remember we've already removed 200 units from the 1,000 opening inventory, so we should be remaining with 800 units there, plus the other 500 units. But the first units to go out under FIFO, first in, first out, is the remaining 800 units from this consignment, the opening inventory. So what we'll do is we'll say 21st of April. The sold units is 1,200. But this 1,200, 800 should come from the remaining units of opening inventory. That should be the first units to be issued or to be sold at $5 per unit. So 800 units multiplied by $5 per unit, 8 by 5, that will give you about $4,000. That's $4,000. So if we issue 800 or sell 800 from the opening inventory at $5,000, we have $4,000 cost of sale. So we are remaining with a balance of 400 units from 1,000, so that we can come up with $1,200. 200 units issued. We've issued 800, we remain with a balance of 400. So where will these 400 units come from? The 400 units will come from the second earliest inventory received. So here's the thing, we had 1000 opening inventory, 1000 units. On the 5th of April, there was a purchase of 500 units. When we issued the phase 200 units, these 200 units were issued from 1000. The balance from 1000 was 800 units. So when we come to make this issue of 1200 units, we have to make sure that the earliest units are issued first, and that's the 800 units. Then the balance of 400 units will be issued from the 500 units that were received on the 5th of April. We're following the model of phased in, phased out. So the issue here of 400 units will be at the price of $6 per unit. So at $6 per unit. Why $6 per unit? It's because this is the price for the second earliest consignment received or inventory received. It's valued at 6. So if we issue 400 from there, we value that at 6, and we'll be remaining with 100 units from the consignment received on the 5th of April. So 400 by $6 per unit, that should give us 2,400. So you have $2,400. So the total of the issue for the 2nd of April, total of the issue for the 2nd of April is so you say total issue for 2nd April, that issue is about $6,400. $6,400. That's the total for 21st, sorry, total for 21st April's issue. So there we are. That's the 6.4. So in conclusion, the total cost of issue for the whole period, will be the 1,000 cost of issue for the 200 units issued on the 9th of April, plus the total cost, which is 6,400 for the 1,200 units issued on the 21st of April. So total cost of issue issues will be equals to $1,000 plus $6,400. This will be equals to $7,400. So that's the total cost of issue. What is the cost of inventory remaining? Closing inventory. Let's go back to the table. The units, the opening inventory units are all issued out. Remember, we took a 200 from 1,000. We remained with 800. 800 was issued on the 21st of April. Then from the purchases received or inventory received on the 5th of April, 500 units in total. We've already issued 400 units out of the 500, so we are remaining with 100 units. Plus the units received on the 14th of April, that's the 600 units. We've not touched this consignment and FIFO. So the closing inventory is 100 units at $6 per unit, plus the 600 units at $5.5 per unit. So you will say closing cost of closing inventory This is going to be 100 units at $6 per unit, plus the other one is 600 units at $5.5. So type that into the calculator. You should have $3,900. $3,900. That's the cost of, that's the value of closing inventory. That's the value of closing inventory. So there we are. The total cost of issue, 1,000 for the issues made on the 9th of April, plus 6,400 in total for the issues made on the 21st of April. And that gives us a grand total of 7,400 units. Value of closing inventory, we have 100 units remaining at $6, plus the 600 units that were received on the 14th of April at $5.5, and that gives us a total of those two figures. That's how we calculate the cost of issues and the value of closing inventory under FIFO. Let's look at how cost of issues and value of closing inventory is calculated under LIFO method. Now, under LIFO method, we are assuming that the inventory that was received last is the first to be issued. Inventory received last is the first to be issued. So let's go to the solution part using LIFO. Last in, first out. So the issue on the 9th, 200 units that we are issuing on the 9th of April will come from the latest consignment received, and the latest consignment received is the 500 units that were received on the 5th. So we issued 200 units from that, and so the units will be issued at the price of $6 per unit. So issue on the 9th of April. 9th April. So issued is 200 units at $6 per unit, and obviously that will give us 6 by that, something like $1,200. $1,200. That's the cost of issue for the 200 units issued on the 9th of April, $1,200. So if you get back to the table, 200 units have been issued from this consignment, so we should be remaining with 300 units from the units received on 5th April. We are remaining with a balance of 300 units there. The next issue is 21st of April. We're issuing 1,200 units. These units, according to LIFO, last in, first out, will come from the latest consignment received. The latest consignment received is 600, so 600 must be issued first. But you know, if you are issuing 1,200 units and you issue 600, there will be a balance of 600 remaining. The balance will be issued from the second latest, and we know that we have 300 units remaining there. So the 300 units remaining from the consignment received on the 5th of April should be the next to be issued. Now we've issued 600, we've issued 300, we still remain with a balance of 300 units. The remaining 300 units will be issued from the opening inventory of 1,000 units. So like this. Issue on the 21st of April. We issuing or selling a total of 1,200 units. but these will be issued as follows. First, the 600 units, which is the latest consignment, will be issued at that price. So 600 units will be issued at 5.5. So at $5.5, how much will be the cost? Issued at 5.5, the cost should be $3,300. $3,300. The next thing we do is we are still remaining with a balance of about 600 units to complete the issue of 1,200. So we go back upwards. We know that we are remaining with 300 units here, so we issue the 300 units remaining at the price of 6. So it's 300 units issued at $6 per unit. That is going to be $1,800. The next one is when we issue 600 and 300, the total number of units issued so far is 900. We're still remaining with about 300 units that must be issued in order for us to complete a 1,200. So the 300 units that should be issued comes from there. These units are gone, those units are gone. So at this stage, the latest that we have is from the 1,000 units. So we issue 300 at that price. So issue 300 units. Another 300 units are issued at the price of $5. Issued at $5 per unit. When you do that, how much do we have there? Issued at that price, we have $1,500. $1,500. And so the total cost of issue at this stage, total cost of issue for the 21st of April will be equals to, so we had up 3,300, 1,800 and 1,500. The grand total there should be $6,600. So we have $6,600. So what's the total cost of issue for the period? So total cost of issue for the period will be equals to, total cost of issue for the period is the 6,600, which is the total cost of issue for 21st of April, plus the 1,200 total cost of issue for the 9th of April. So when we add this and that, it will give us 7,800. That put together, you should have 7,800. So we have $7,800 as the total cost of issues for the whole period. $7,800. So we've calculated the cost of inventory used or issued. What's the cost of closing inventory? What's the cost of closing inventory? Now let's come back to our results here. These units, 600 units have already been issued, 500 units have already gone, and we have touched 300 units from the opening inventory of 1,000. So we should be remaining with about 700 units from this consignment at that price. So the value of closing inventory, inventory value will be equals to remaining with 700 units at $5 per unit. 700 units at $5 per unit. This will give us $3,500 per unit. That's the value of our closing inventory. That's the value of our closing inventory. So let me go through this part again. On the 9th, we issued 200 units. From the latest consignment received 500, we have 1,200 as a cost of issue. On the 21st, we issued 1,200 units in total. 600 was coming from the latest, then 300 from the second latest, and the 300 from the third latest inventory received. And these are the total values, and so the cost of issue on that particular day was 6,600. Put this and that together gives us the total cost of issue for the period, 7,800. And so the closing inventory will be the 700 units remaining, and these units are all coming from the opening inventory of 1,000 units, and so that's why we valued these units at $5 per unit. Now let's move on to the third method of inventory valuation, or method of pricing issues. The third one is the accumulated average. The accumulated average method, under this method you have to calculate the average cost at each stage you make an issue. So as part of the solution, there we go. So putting just this data in a table, we have something like this. 1st of April we have that, 5th of April we have that, and then we are issuing on the 9th of April. So here you need to calculate the average cost. The average cost at every stage you had new inventory to stock. Calculate the average cost. How do we calculate the average cost? The average cost is equals to the total cost divided by the number of units. That's the average cost. Total cost, or total value of inventory divided by the number of units of that inventory. That's the average price or average cost. So the value of the 1,000 units opening inventory at $5 per unit is $5,000. So the value of that is $5,000. The value of 500 units at $6 per unit, it's 500 multiplied by 6, that should be about $3,000. That's the value. So the total, let's insert hello. So the total here, total value of the units in inventory is $8,000, and the total number of units is 1,500 units. 1,500 units. These are the totals. So the average price or average cost, the average will be equals to $8,000 divided by the number of units, 1,500 units. This will give us $5.33. So $5.33, that's the average. So the unit price for the 1,500 units that we have there should be $5.33. That's the unit price. So this inventory here, 200 units will be issued at the average price, average cost of 5.33, and the cost of issue is going to be 200 multiplied by 5.33. 200 multiplied by 5.33, that is going to be $1,067. So we have that cost of issue, $1,067. $1,067. So what are we remaining with after that? After this issue, we should expect that the units remaining will be 1,500 units that we had before we issued 200. Now we have issued 200, and so we should remain with 1,300 units. Here, in terms of money, how much is remaining? These 1,300 units are valued at 5.33. Then 8,000 minus 1,067, 8,000 minus that, we should remain with 6,933. 6,933. So we have $6,933 as the value remaining. After this stage, there is a purchase of 600 units at the value of 5.5. The total value of the 600 units is 600 multiplied by 5.5. So 600 by 5.5 should give us $3,300. $3,300. So at that stage, the total value of the units we have in inventory is $6,933 plus $3,000, $3,300. We have $10,233. $10,000, 233. $10,000, 233. That's the total value, and the total number of units that we have at this stage should be the 1,300 units we were remaining with plus the 600 units that has been purchased. The number of units should be 1,800 units. So the state of affairs at this stage after the 14th is going to be 1,800 units at a total value of 10,233 units. Let's calculate the new average. The new average is going to be, what's the total cost? It is 10,233 divided by 1,800 units. 1,800 units. When you divide that, how much are you getting? So that divided by that should give us 5.386. 5.386. Sorry, one mistake here. 1,300 plus 600, that should be 1,900, not 1,800. So we have 1,900. Even here we have 1,900. Sorry for that. So when you divide 10,233 divided by 1,900, you have 5.386. 5.386. So this is valued at 5.386 $386. Just say 39, rounded off to 2 decimal places, you have 39. All right, so the inventory in stock will be valued at 5.39, and that will be the total value. So when we come to issue 1,200 units, of course we put that in brackets. We are issuing 1,200 units. These units will be issued at 5.39 per unit, and so the total cost of that issue is going to be 6,463. Total cost 6,463. 6,463. That's the cost of issue there. All right, so if we issue that at that value, subtract it from the amounts we had in terms of units, the closing inventory value will be, the closing inventory units will be 700 units, and the closing inventory value is 10,233 minus 6,463. That will be 3,770. So we have 3,770 770 as the closing inventory value. These units are valued at 5.39. So value of closing inventory, that's the value of closing inventory. That's the value of closing inventory value. What's the total cost of issue? The total cost of issue will be cost of issues. Cost of issues, the total number of units issued will be 200 units issued on the 9th of April plus 1,200 units issued on the 21st of April. That's going to be 1,400 units issued. Non-applicable for the issue price because these were issued at different prices, but the cost of issues is going to be 1,067 plus 6,463. So just adding those figures, we can use that space to try and work out the sum of those figures. So we have 1067 plus the other issue costed 6,463. So those two figures put together, we should have let me just punch that in the calculator. So you have 1067 plus 6463. You should have 7,530. 7,530 is the total cost of issues. 7,530. So we have 7,530 as the cost of issues for the period. Then the last method of inventory valuation is called the periodic average cost method. With this particular method, you have to calculate the average cost of issues right at the end of the period. So let's bring the question down there. So what you do is you just add all the values, all the total value of purchases or units received, and then divided by the total number of units received, you've gotten the average cost per unit. So 1,000 by $5 per unit, that's 5,000, plus 500 by $6 per unit, that's 3,000. Then plus 600 by 5.5 per unit, that's 3,300. Add those things and then divided by the number of units. Number of units is going to be 1,000 plus 500 plus 600, 2,100 units. So you say solution, periodic average cost equals what's the total value of units received. We have a 5,000 coming from opening inventory plus 3,000 from inventory received on the 5th of April, then plus 3,300 from the inventory received on the 14th of April. So that's the total value. Total value divided by the number of units. So on the number of units, we have 1,000 units opening plus 500 units received on another date. We'll check the date, plus the 600 units. So that completes the number of units. Going back to our results, we've added 1,000 units plus 500 units plus 600 units, giving us to 1 plus the total values. So this is equals to 5,000 plus 3 plus that is 11,300. 11,300 divided by the number of units, that's 2,100. So what's the average? Average is 5.381, 5.38. So the average is 5.38. So all issues will be done at 5.38. So how many units are we issuing out? We are issuing out 1,400 units. So when you come to calculate the cost of issue, cost of issues, cost of issues, 1,400 units have been issued, but these are issued at, sorry, this is not dollar. 1,400 units have been issued at the price we calculated, 5.38. And so the total cost of issue is going to be $7,533. $7,533. What's the cost of closing inventory? Closing inventory value. How many units will be remaining after issuing 1,400? There were a total of 2,100 units. You issue 1,400 units, you should be remaining with about 700 units, and these units are issued at the same average cost, 5.38. So what's the total cost of, what's the total value of closing inventory? Tap that in the calculator, you have 3767. So that's 3,767. 3,767 is the cost of, is the value of closing inventory. So closing inventory value, we have it there. Cost of issues value is there, and that's the periodic average cost method. Periodic average cost method. Probably this is the simplest of the four methods. So we have inventory issued at different costs according to the inventory valuation methods, which are FIFO, REFO, average accumulated costs, and the periodic average cost. So under FIFO, we are assuming that the inventory that came in first should be the first to be issued. Under LIFO, we assume that the inventory that came in last should be the first to be issued. Under average cumulative cost, we calculate the average cost before making an issue, or whenever material is added to inventory, a new average cost is calculated. Periodic average cost, we calculate the new average cost at the end of the period, and we use that to calculate the cost of issue for the period and the value of closing inventory. Thank you so much for sparing your time to listen to this particular video.